All right, so first up is deferral. So we'll go over the specifics of how these work. Again, so what the main task of the business here is determining which prepaid expenses have expired and which unearned revenues have been earned. It's as simple as that. Right, in every instance, there's been a past transaction that's taken place. So that's the good news here. So it's very easy to figure out what your deferrals are. So what I did here is I gave you demonstrations of like what the previous transactions were that ultimately lead to the need to do the deferred entries. Right, so this is, again, going to be for December of 2019. And again, the chart of accounts for this company has expanded greatly from the original example, which was fairly straightforward. So here are the things that happened during the period that are going to necessitate the need to record some deferred entries. Right, so number one, they purchased supplies, $4,000 on account. And again, the balance prior to this is dovetails with the previous example, was $1,000. So they had to book as a result of that, which you're looking at right here. So supplies, debit, accounts payable, credit for the $4,000. Paid rent 3 months in advance, $30,000. So that necessitated this entry right here, prepaid rent debit, cash credit. Also business insurance, good idea, right? So they're insuring their assets. So prepaid insurance, debit, cash credit for the $6,000. Again, this is for 6 months. Periods of time are important because that's going to influence what our adjusting entries ultimately look like. Number four, they purchased an additional delivery truck for $25,000. So trucks, debit, cash credit. So in other words, they have 11 trucks now, a total of $275,000 on hand, which we'll talk about momentarily. It'll be a little bit later. And then lastly, they received $20,000 in advance for services yet provided, so that necessitated this. So cash debit, and there's our unearned fees account. Right, so again, these are all previous transactions sitting on the books, things that they can just clearly look at, clearly go, oh yes, I see we booked that over here, and now we have to update something. So that's what you're going to see on the next slide here. And again, this is the information that we collected from that. In other words, we looked at, first up, supplies used during the month were $4,500, or remaining supplies are $500. That's more realistic. So in other words, out of $5,000 worth of supplies, they had $500 still remaining. That led them to book this transaction right here. Again, look familiar. You've already seen this before. Supplies expense debit, supplies credit. Little sidebar about deferred expenses. In other words, there's two possible angles that they can tell you when they're referring to this. In other words, the information set that you're given in your homework can be, I'm giving you both angles right here. In other words, supplies used or what's remaining. Now, in the first instance where I give you the $4,500, I'm giving you the exact amount of what? The expense, right? I'm telling you the expense is exactly $4,500. So in the case of, if I give you in the deferred expense entry, a prepaid expense, if I say this is what the amount of expense is, that's the amount you book. You're done. On the other hand, if I tell you the asset angle, that's what this is. In other words, this is what should still be sitting in assets. Yes, that does say assets, I swear. Do you think I should be getting better with this? Nah, not happening. Anyway, so what if I give you the asset angle? Well, in that case, then you have to do some math. So in this case, the math would be what? Again, there was $5,000 worth of supplies on hand minus the 500 equals the same entry. So you get the same entry, but the means to it, how do you get to that number, is you have to do a little math to get the correct amount. So beware of that when you're dealing with your deferred expenses, your prepaid expenses, because depending on which angle they're telling you can change your interpretation of it. So that's the thing you got to keep in mind here. Right. In the case of 2 and 3, I both just say that a month's worth of either the prepaid rent or prepaid insurance has expired, so you have to figure out what was the rate they were paying. So over here they were paying divided by 3 means it was probably what, $10K was the amount that they were paying per month, versus here divided by 6 equals it was $1,000 straight up. So that means we're going to expense $10,000 of the prepaid rent, $1,000 of the prepaid insurance, and that's what you'll observe here. So the rent expense debit, prepaid rent credit for 10, and then the other portion is the $1,000 of insurance expense debit, prepaid insurance credit. All right. Now in the case of the fourth one here, they're going to calculate depreciation on the 11 delivery trucks as $3,125. And again, a later chapter covers the methods used to calculate depreciation expense. So for now, you're only going to have to understand the basic debit and credit, which is right here. And that is, you'll have to understand that you debit depreciation expense For trucks, 3125, and the new account that we'll discuss momentarily, accumulated depreciation on trucks is your offsetting credit there. We do not book anything directly to the trucks account when you're dealing with depreciation. And then lastly, number 5 is we have of the advance payments of fees, $6,000 a month and remain unearned. Now there's also a similar lesson for your unearned revenues, that is deferrals of revenue. 2 angles can be given there. I can give you either, hey, here's the amount of the revenue that we earned, and that's the amount you booked, you're done. Or I can say, hey, here's what still should be sitting in the liability account after the adjusting entry, and then you have to do a little math. Now remember, the amount that we had originally booked was $20,000 of this. Again, that was for services yet provided. Somebody paid us $20,000 in advance, or maybe more than one customer. I'm not specific on that. And then I tell you all of those advance payments, $6,000 a month, and remain. What's the key word here? Unearned. So if they're still unearned, that means that that's the amount that should be sitting in the unearned fees account after adjustment. So you're going to have to take the $20,000 minus the $6,000 equals the correct amount of the adjusting entry, which is $14,000. So you should take $14,000 out of unearned fees and then reclassify that as fees earned. So that after you book that entry, you'll have this much left in the account. Ultimately, I could have said $14,000 are earned, and it would be the same entry. That's what I'm talking about. Again, revenue angle, you're done. If I give you the liability angle, then you got to do the math. Before I sign off on this deferral video, we've got to talk about the depreciation expense entry. In other words, exactly what's going on there. Now, the logic behind this is since fixed assets have a future utility in excess of 1 year, it'd be kind of weird if we directly credited them every time we depreciated them. So instead, to handle that problem, we're going to use a contra asset account called accumulated depreciation. And again, what's the nature of this account? It's a real account. So this is fits into the real versus temporary paradigm that we talked about. So in other words, it's part of the balance sheet, so it's real, it's a permanent account. Normal balance is a credit, not a debit, because why? It's an accumulation of what? All depreciation expense taken on those fixed assets, and it represents valuelessness, or the perception of valuelessness, let's call it that. Back it up a little bit. Contra asset. So what's contra short for? Contra could be short for contradictory or contrary. If something's contradictory, it's basically the opposite. So what you're looking at is the opposite of an asset. In other words, when you look at the asset account trucks, you're looking at, okay, that's the value that we perceive of, whatever the purchase price was of our trucks, and this contra asset, the accumulated depreciation, should be perceived as the amount that we have devalued it, since we've purchased them in total, if you're looking at the total value there of that account, total amount there. Now, the way to look at those accounts, like a fixed asset account and its related accumulated depreciation account, is think of them as being, in essence, married, which makes sense because why? Because the little saying, opposites attract. So if you want to understand what the book value of a fixed asset is, you have to take the fixed asset as purchase price of that less related accumulated depreciation account. In that case, you'll understand what its book value is. So in this case, it would be $271,875 because we paid $275 for the trucks, and here's our depreciation to date. Right? So of course, we'll see that accumulated depreciation number go up over time as we record more and more depreciation expense. This is a very important point right here. This note: depreciation is an allocation, not valuation method. We're not attempting to determine disposal value or replacement cost of the trucks. Those are 2 ways that we would consider to be what the fair market value is. Again, they're different and they're different numbers, but they fall into the heading of what the current fair market value is. Disposal value is what we would get for it if we sold it. Replacement cost is what it would cost us to get the same thing back in the same condition. And again, we have looked into this in the past in accounting and thought about, well, should we enjoin a real world depreciation? And the answer was no. Why? Because again, we'll go back to the concepts of materiality and cost benefit. It's costly, right? Was there any real benefit to doing it? No, and it would prove to be a fairly costly system because why? There was probably no material difference in how external users are going to view a real world depreciation versus what more or less is an arbitrary set of methods. So, and again, here's the idea here. Since all corporations are going to use the same arbitrary methods, we get comparability. That's very important. So because comparability isn't compromised, by doing something arbitrary, there's no value really to doing quote-unquote real-world depreciation. So that's why we're going to completely just skip that idea. Right, so what I'm going to do in the next panel there is a little free form, is show you, like, what if we kept depreciating these assets until they had a zero book value. So what we're going to look at the system that we employ versus a theoretical system that doesn't use the accumulated depreciation account, just to emphasize how the information set changes if you go from one to the other. All right, to spare you the insanity of watching me try to draw all this stuff up here, I did it ahead of time before resuming this video. So again, what you're looking at here, again, on this side of the divide over here, you're looking at what we could theoretically do, right? We could just book everything in trucks instead of having, this is what we do over here. We have trucks and accumulated depreciation. Trust me, that says accumulated depreciation right there. ACC, period, DEPR. Oop, there's the period. And over here, this is BV for book value. Right, so after the period of depreciation that we've covered so far, that would be right here. They both agree. Both systems say that, guess what? The book value of the trucks is $271,875. Where they depart a little bit, though, is this. In the system that we shouldn't be using, again, we just have a trucks account, that one says we have a balance of $271,875 in trucks after you subtract the $31.25. The story we get in the trucks minus accumulated depreciation world, the one we're inhabiting, is we have trucks that we paid $275 for, we've depreciated $31.25, yielding this book value. So there's a little bit more of a complete story there. Now what I'm positing here is let's continue depreciating these trucks till their book value is nothing, right? There's a goose egg there, so that's what the $271,875 represents, just remaining value, and same thing over here. Now, if we look over at this one right here, the one we don't want to emphasize, I look at the balance of trucks, I just see this. Big old zero, right? There's nothing there. I didn't say we sold anything. I just said that we depreciated them. That's an important distinction. Now, if I look over at our universe that we want to emphasize here, so we're over here. Now the information set is trucks we paid $275 for have been depreciated $275, resulting in a null value there. So the fact that we have these numbers on the books represents value. That's how we represent value of a fully depreciated asset on the books, and we should, because why? They're generating revenues because it's delivery service. We're also making us incur expenses, because why? Because we have to repair the trucks, we have to insure them, and so on. So because they're having an impact on the business, they should be embedded somewhere in our accounting system. So that's how they're embedded. Also, this system that we're employing gives us the opportunity to demonstrate what it looks like if you dispose of one of the trucks. Let's say we're going to throw one of the trucks away for $25,000. That's what we paid on average. So how would that look? Well, you would need to take $25K out of accumulated depreciation, that's the K there, trust me, and take the same amount out of the account trucks. So that's how you would handle a disposal. In this case, we're just throwing it away. So you would debit out of accumulated depreciation, credit out of trucks, and that would mean, oh, we no longer own that truck. It's no longer in our possession. We'll discuss more of what that looks like, that's in Chapter 9. So that's in a much further out chapter before we'll give you what the ins and outs are of that. All right, that concludes the deferral video. Look for the next one, which will cover the topic of accruals. See you there.